Listen, stop what you're doing right now. I need 60 seconds of your complete attention because what I'm about to share with you is not clickbait, it isn't speculation, and it definitely isn't something you'll hear on mainstream financial news. This is information that powerful people don't want circulating freely. This is the kind of intelligence that moves between boardrooms and hushed tones, the kind that separates those who survive financial earthquakes from those who get buried under the rubble. Right now, at this very moment, one of the most powerful banks on planet Earth is quietly executing an emergency exit strategy. Not tomorrow, not next week, now. And if you don't understand what that means, if you don't grasp why that matters, you're about to learn a very expensive lesson. But here's the thing, you still have time. Not much, but enough. Enough to understand what's happening. Enough to make decisions that could protect everything you've worked for. Before we go 1 second further, I need you to do something for me. Hit that subscribe button right now, seriously. Don't wait until the end of this video, do it now. Because Dark Economy exists for one reason only, to show you what's happening behind the curtain before the curtain gets ripped down entirely. Most people find this channel after the damage is done, after their portfolios have been decimated, after they've lost everything they thought was safe. Don't be most people. Subscribe now, turn on notifications, because the information you're about to hear is just the beginning. Trust me, you're going to want to see what comes next. Now let me tell you what just happened, and more importantly, what it means for your financial future. Inside Morgan Stanley, one of the absolute giants of global finance, something unprecedented just occurred. I'm not talking about a press release. I'm not talking about something they announced to the public. I'm talking about an internal communication that went out to a very specific group of people. The ultra-wealthy, the hedge funds, the institutional players who move billions of dollars with a single phone call. And that communication contained a directive that should send chills down the spine of anyone paying attention. Exit all silver positions. Immediately. Completely. No exceptions. Now, I know what some of you are thinking. Banks tell clients to adjust positions all the time, right? They make recommendations. They suggest rebalancing. That's just normal business. But here's what you need to understand. The language matters. The specific words they choose matter more than you realize. Banks don't use the word exit casually. They don't tell clients to evacuate positions unless something is fundamentally broken. When Morgan Stanley uses that word, when they set a hard deadline, when they tell clients to get out of both long and short positions, futures, options, swaps, everything related to silver, they're not making a suggestion. They're sounding an alarm. Think about this for a second. Morgan Stanley manages trillions in assets. Trillions. They have some of the most sophisticated risk models on Earth. They employ hundreds of the smartest quantitative analysts, mathematicians, and strategists money can buy. These are not people who panic over market noise. These are not people who abandon profitable trading desks because they had a bad feeling. When an institution of this magnitude tells its most important clients to evacuate a market entirely, it's because their models, their data, their internal intelligence is showing them something the rest of us can't see yet, something catastrophic. And here's the really terrifying part. This directive wasn't sent to retail investors. It wasn't posted on social media. It wasn't announced on CNBC. It went to the people who matter, the people who always get warned first. This is the exact same pattern we've seen before every major financial collapse in modern history. The smart money gets the heads up. The smart money exits quietly. And by the time regular people figure out what's happening, the exits are already jammed, the prices have already moved, and the damage is already done. So what does Morgan Stanley see that we don't? What are their models showing them that's scary enough to abandon an entire market? Let me break this down for you piece by piece, because once you understand the mechanics of what's happening, you'll realize this isn't theory. This is mathematics. This is physics, and it's already in motion. The first crack in the foundation is inventory, physical inventory. The actual metal that can be delivered when someone demands it. See, the silver market operates on two levels. There's the paper market, where contracts get traded, where prices get quoted, where trillions in notional value change hands every day. And then there's the physical market, where actual silver, real metal you can hold in your hand, actually exists. For decades, these two markets moved together. The paper market represented the physical market. The prices matched. The system worked. But something fundamental has changed. The registered silver inventory, the metal that's actually available for delivery through exchanges like COMEX, has been collapsing. Not gradually, not slowly, rapidly. We're talking about millions of ounces disappearing from vaults week after week after week. Just a few months ago, these inventory levels were comfortable. Banks weren't worried. Traders weren't concerned. But now we're at levels that should make anyone with exposure to this market extremely uncomfortable. And it's not just the absolute level that matters. It's the velocity. It's the speed of the decline. When inventory disappears this fast, it tells you something critical. It tells you that physical demand is overwhelming the paper supply. It tells you that people are taking delivery of actual metal instead of just trading contracts. And that changes everything. Because the entire system, the entire structure of the commodities market, is built on the assumption that most people never want delivery. The system depends on contracts rolling over, on traders settling in cash, on the physical metal staying safely in vaults while paper claims get shuffled around. But when people start demanding the real thing, when they stop accepting paper promises and start asking for metal, the illusion collapses. Now, some analysts will point to something called eligible silver. They'll tell you there are still millions of ounces sitting in vaults, so there's no real shortage. But here's what they won't tell you. Eligible doesn't mean available. That metal belongs to private owners. It's not the exchange's safety net. It's not sitting there waiting to be delivered to contract holders. Those owners can choose to make their metal available for delivery, but why would they? If physical premiums are rising globally, if demand is surging, if the paper market is showing stress, those private owners have zero incentive to release their metal at suppressed paper prices. That silver is effectively locked. It's off the table. And Morgan Stanley knows this. Their risk managers understand that when a crisis hits, when delivery demands surge, that eligible silver isn't coming to save the market. The second pressure point, and this is where things get really dangerous, is delivery behavior. Historically, the commodities futures market operated on a simple principle. Traders didn't actually want the commodity. They wanted price exposure. They wanted to speculate on price movements. They wanted to hedge other positions. But they didn't want truckloads of silver showing up at their door. So contracts would roll over month after month. Very few people ever stood for delivery. The whole system depended on that behavior. It was predictable. It was stable. It worked. But that behavior is changing. Right now, in real time, more and more contract holders are standing for delivery. They're not rolling their positions. They're not settling in cash. They're demanding the physical metal. Yeah. And every time someone does that, every time a contract gets converted into actual delivery, it puts stress on a system that was never designed to handle significant physical settlement. Think about the math here. The paper market trades hundreds of millions of ounces. The physical market, the actual metal available for delivery, cannot support anywhere near that volume. It's not even close. If even a relatively small percentage of contract holders decide they want delivery instead of cash settlement, the entire system breaks. Not might break, not could break, will break. It's mathematical certainty. And there isn't enough physical metal to back the paper claims. There never was. The system was built on leverage, on the assumption that demand for physical delivery would remain low. But that assumption is failing. And when too many people show up at the same time asking for metal that does not exist in sufficient quantity, you don't get an orderly market adjustment. You get a default. You get a crisis. You get chaos. And that brings us to the third threat, the one that keeps risk managers awake at night. Counterparty risk. This is the invisible killer in modern financial markets. See, what most people see when they look at the silver market is the public face. The comics quotes, the ETF prices, the futures contracts trading on exchanges. But behind that public market exists a massive shadow system, private contracts, bilateral swaps, over-the-counter derivatives, obligations between institutions that nobody outside those institutions even knows exist. We're talking about trillions in notional exposure, positions so large that if they go wrong, they don't just hurt one bank, they threaten the entire system. Many of those shadow positions are short. Banks and institutions have bet that silver prices would stay low or fall. They've sold promises to deliver metal they don't own. They've written contracts assuming they could always buy physical silver at reasonable prices if they ever needed to. But what happens when physical prices start disconnecting from paper prices? What happens when the metal they need to cover those short positions suddenly is unavailable at any reasonable price? Those positions start bleeding fast. And when you're talking about leverage this extreme, when you're talking about positions measured in billions or tens of billions of dollars, even small price moves can create catastrophic losses. Morgan Stanley sits at the center of the interbank system. They see the flows. They see the stress. They can see when other institutions are scrambling for collateral. They can see when someone is drawing emergency liquidity. They can see when a counterparty is starting to wobble. And once they see that, once they realize that one domino is about to fall, they know what comes next. Because in the interconnected world of modern finance, no institution fails alone. When one bank can't meet its obligations, it triggers a cascade. The institution that was owed money suddenly has a hole in its balance sheet. That hole forces them to liquidate other positions. Those liquidations put pressure on other markets. Other institutions face unexpected losses, and the contagion spreads. This is how financial crises accelerate. Slowly at first, then all at once. These three pressures, collapsing inventory, surging delivery demand, and exploding counterparty risk, they don't exist in isolation. They feed each other. They amplify each other. Falling inventory creates fear. Fear increases delivery demand because people want to make sure they can actually get metal. Increased delivery demand forces short sellers to cover their positions. Short covering drives prices higher. Rising prices attract more buyers. And physical premiums, the extra cost for actual metal versus paper contracts, explode. It's a feedback loop. And once that loop reaches a certain velocity, once it passes a critical threshold, it cannot be stopped. It has to run its course. And history shows us that when these feedback loops run their course in commodity markets, the results are spectacular and devastating. Morgan Stanley's models are showing them that we're already inside that acceleration phase. That's why the timeline matters. That's why they set an end-of-month deadline. See, month-end accounting is when banks have to expose their balance sheets to regulators. Every position has to be marked to market. Every loss has to be counted. Capital ratios have to be calculated. If silver positions implode during that window, if prices spike or crash violently, if delivery failures start cascading, Morgan Stanley's capital ratios could take a serious hit. Their credit ratings could be questioned. Their access to liquidity could tighten. And in modern banking, liquidity is everything. Without it, you're dead. By exiting before month end, Morgan Stanley isn't just protecting profits. They're protecting their survival. They're making sure that when the system breaks, when the contagion starts spreading, they're not holding the bag. They've seen this movie before. History repeats. 1980, the Hunt brothers tried to corner the silver market. Prices exploded. And the rules changed overnight. Exchanges limited buying, they raised margins. They effectively changed the rules mid-game to prevent the system from collapsing. People who thought they were going to make fortunes got wiped out. The institutions survived. In 2008, Lehman Brothers collapsed on a Monday morning. But the smart money, the connected players, they'd started exiting weeks earlier. They saw the stress building. They moved their positions quietly. By the time the public panicked, the early movers were already safe. In 2022, the London Metal Exchange canceled billions in nickel trades when prices spiked out of control. People who had winning positions, people who had been right about the market, got their trades erased to save the system. Winners were turned into losers with the stroke of a pen. When markets break, rules always change, always. And when rules change, someone always pays the price. Morgan Stanley is making absolutely certain it won't be them. So ask yourself this question. Why would a bank walk away from fees, from trading revenue, from client relationships, from all the profits that come with running a commodity desk, unless the risk of staying in that market was existential? They wouldn't. The only rational explanation for this behavior is that their models are showing them something so severe, so dangerous, that no amount of profit is worth the risk. Now here's the part that most people miss, the part that's going to cause absolute chaos for unprepared traders. When a giant player like Morgan Stanley exits both long and short positions simultaneously, when they close everything and walk away, it creates a vacuum. Liquidity evaporates, market depth disappears, and volatility becomes violent. We're not talking about normal price fluctuations. We're talking about moves that make no sense. Prices spiking hundreds of dollars in minutes. Prices crashing just as fast. Stop losses getting triggered everywhere. Bid-ask spreads exploding so wide that you can't execute trades at any reasonable price. Markets stop functioning normally. They seize up. And here's the really twisted part. Paper silver might crash while physical silver surges. At the same time, that divergence, that breakdown of the relationship between paper and physical, that's the signal. That's how you know the system is breaking. But by the time that divergence becomes obvious, by the time it's clear enough that mainstream media starts reporting on it, it's already too late. The early movers are already out. The exits are already jammed. And regular investors are left holding positions they can't exit at prices that don't make sense. Most retail investors are still watching charts. They're still trusting ETFs. They're still believing that the spot price they see quoted represents reality. They don't realize that the largest, most sophisticated players are already halfway out the door. They don't understand that the game has already changed. This is always how it happens. Always. The institutions exit first. The smart money moves quietly. And by the time the average person realizes something is wrong, it's already over. So what should you do with this information? How should you think about this? First, you need to understand exposure. Really understand it. Paper is not metal. An ETF share is not ownership of silver. A futures contract is not a bar sitting in your safe. These are different things with very different risk profiles. When system stress hits, when confidence collapses, paper promises fail first. They always do. Physical assets, things you can actually hold, maintain value. Paper claims get disputed, delayed, defaulted on. Second, timing matters. Windows of opportunity close quietly and quickly. Physical premiums can explode overnight. Availability can disappear without warning. Dealers run out of inventory. Delivery times extend from weeks to months. Prices become negotiable instead of fixed. By the time everyone realizes they want physical metal, it's already too late to get it at reasonable prices. The early movers pay spot plus a small premium. The late movers pay spot plus enormous premiums if they can get metal at all. Third, ignore the noise. Volatility is a feature, not a bug. Violent price swings are designed, whether intentionally or not, to scare weak hands out of positions at exactly the worst moments. People see their positions down 20% and panic, sell at the bottom. Then they watch from the sidelines as prices recover and surge higher. The emotional decisions during volatile periods almost always turn out to be wrong. You need to think like a risk manager, not a gambler. Risk managers ask, what's the worst case scenario? What happens if I'm wrong? What happens if the system breaks? What happens if my counterparty can't deliver? Gamblers ask, what's the potential upside? How much can I make? What if I'm right? And finally, think about asymmetric risk. That's the key concept here. If nothing happens, if Morgan Stanley is wrong, if the system holds together and silver just trades normally for the next year, what's your downside? If you own physical metal, you still own a tangible asset with thousands of years of monetary history. You haven't lost anything fundamental. But if something does break, if the system fails, if defaults cascade, if paper and physical prices diverge catastrophically, what happens to paper holders? They hold nothing. They have claims in a broken system. They're waiting in line with thousands of other people trying to get metal that doesn't exist. That's asymmetric risk, limited downside, massive upside. That's the setup that sophisticated investors dream about. Before we go any further, I need you to do something else for me. Leave a comment below. Tell me what you think happens next in the silver market. Not guesses, not hopes, reasoning. What does your analysis tell you? What are you seeing in your own research? Comment engagement matters because it helps this video reach more people. It pushes this information to people who don't even know they're at risk yet. People who still think their paper positions are safe. People who trust that the system will work the way it's supposed to. They need to hear this. And the algorithm needs to see that this video matters, that people care about this information. Also, share this video, seriously. Think about someone you know who's invested in silver, someone who trades commodities, someone who thinks markets always stay orderly and fair. Send them this video, because history disagrees. Markets don't stay orderly. Rules change when powerful people need them to change, and the people who survive are the ones who see the pattern before it completes. Now let me paint you a picture of what the next few weeks and months might look like. We're in uncharted territory here, but we can make educated predictions based on market mechanics and historical precedent. If delivery demands continue to surge, if more contract holders decide they want physical instead of cash settlement, COMEX is going to face a choice. They can either deliver metal they don't have, which means default, or they can change the rules. They can force cash settlement. They can raise margins to make it too expensive to hold positions. They can limit position sizes. They can do what exchanges always do when the system is threatened. They can change the game mid-play. When that happens, and I'm not saying if, I'm saying when, because it's happened repeatedly throughout history, volatility will explode. Price discovery will break down. Paper markets will behave erratically, and physical markets will separate entirely. Physical premiums will surge. Dealers will struggle to source metal. Delivery times will extend. Some dealers will stop offering prices entirely, moving to a call for quote system where every transaction is negotiated individually. That's not normal market behavior. That's scarcity behavior. At the same time, the paper price might actually fall. Sounds contradictory, right? But it's happened before. When forced liquidation hits, when margin calls cascade, when traders have to sell everything to cover losses, prices can crash even as physical scarcity increases. We saw this in March 2020. Paper gold and silver crashed while physical premiums exploded and dealers ran out of inventory. The two markets completely divorced from each other. It was chaotic, and most people didn't understand what was happening. The institutions that see this coming, that understand the mechanics, are positioning themselves now. They're exiting paper positions. They're securing physical metal. They're reducing counterparty exposure. They're making sure that when the chaos hits, they're positioned to survive and potentially profit. The institutions that don't see it coming, or that see it but move too slowly, are going to face catastrophic losses. Some might not survive. And when large institutions fail, when counterparty chains break, the damage spreads unpredictably. Think about what this means for the average investor. Most people who own silver through ETFs have no idea what they actually own. They think they own silver. They see the price go up and down and assume they're exposed to the silver market. But what they really own is shares in a trust that supposedly holds silver somewhere. Maybe it does. Maybe it doesn't. Maybe that silver is leased out. Maybe it's pledged as collateral for other obligations. The fine print in those prospectuses is intentionally complex. And when crisis hits, when everyone tries to redeem at once, that's when you discover what you really own. Usually it's not what you thought. Futures contracts are even worse. You don't own metal. You own a promise from a counterparty to either deliver metal or settle in cash. That counterparty has obligations to hundreds or thousands of other people. If they can't meet those obligations, if they default, you're stuck in bankruptcy court fighting with other creditors for pennies on the dollar. It could take years. And in the meantime, while you're waiting in line, the metal you thought you owned is being sold at prices that could be 10 times what you paid. You missed the entire move because you owned paper instead of physical. This isn't fear-mongering. This is risk assessment. This is understanding how systems break. Every major financial crisis follows a similar pattern. Leverage builds up slowly, everyone gets comfortable. Warning signs get ignored. A few smart players start exiting quietly, then something breaks. Could be a default, could be a margin call, could be a bank failure. It doesn't matter what triggers it. What matters is that once the trigger gets pulled, once the cascade starts, it moves faster than anyone expects. Positions that seemed safe become toxic overnight. Counterparties that seemed solid suddenly can't meet obligations. And people who thought they were protected discover they're exposed. Morgan Stanley employs some of the smartest risk managers in the world. They have access to data that you and I will never see. They have relationships and information channels that give them an edge. And those people are telling their most important clients to exit completely. Not reduce exposure, not hedge risk, exit. Get out. Now, if that doesn't make you sit up and pay attention, if that doesn't make you question your own positions, then you're not taking this seriously enough. Let me be crystal clear about something. I'm not telling you what to do with your money. I'm not a financial advisor. I don't know your situation, your risk tolerance, your goals. What I'm doing is laying out information that most people don't have access to. I'm connecting dots that mainstream media either can't see or won't report on. I'm showing you a pattern that has repeated throughout financial history. I'm telling you that right now, in real time, that pattern is repeating again. The smart money is moving. The institutions that survive crises are preparing. The people who understand how systems break are repositioning. And they're doing it quietly before the crowd realizes what's happening. That's not conspiracy. That's not paranoia. That's how markets work. Information is never distributed evenly. The people closest to the center always know first. They always move first. And they always protect themselves first. What you do with this information is your choice. You can dismiss it. You can assume that this time is different, that the system will hold together, that regulators will prevent any serious disruption. You can trust that your paper positions are safe, that your counterparties will deliver, that rules won't change when powerful people need them to. That's your right. Or you can look at history. You can look at the pattern. You can ask yourself why Morgan Stanley would abandon an entire market unless something serious was coming. You can think about asymmetric risk. You can make decisions while you still have options. Because here's the brutal truth. When this breaks, when the system fails, it will happen faster than you can react. Markets can gap overnight. Exchanges can halt trading. Rules can change before you can exit positions. Physical metal can become unavailable at any price. Premiums can explode from 5% to 50% in days. And by the time you decide to act, everyone else has already decided the same thing. The exits get crowded real fast. This is exactly why dark economy exists. This channel is dedicated to exposing what happens behind the curtain before the show ends. Most people are watching the performance on stage. They're focused on the prices, the charts, the daily noise. We're watching the people backstage. We're watching the crew prepare to drop the curtain. We're watching the smart money head for the exits. And we're telling you about it while there's still time to make decisions. If you haven't subscribed yet, do it now. This is not normal content. This is not entertainment. This is intelligence. This is pattern recognition. This is connecting information that powerful people would prefer stay disconnected. The people who subscribe to this channel, who pay attention to what we're covering, are the ones who see the crashes coming. They're not surprised when markets break. They're positioned. They're prepared. They're protected. Hit the like button too, not because I need the validation, but because it tells YouTube that this information matters. It pushes this video to more people. And right now, more people need to hear this than ever. Share it on social media. Send it to friends who are invested in precious metals. Post it in trading groups. Get this information out there, because the window is closing. The timeline Morgan Stanley set for their clients ends this month. That's not arbitrary, that's strategic. They want their people out before something happens. Let me address something that skeptics always bring up. They'll say markets have been predicting crashes forever. They'll say gold bugs and silver bugs always think the sky is falling. They'll point to all the times people warned about market collapses that didn't happen. And you know what? They're not entirely wrong. There are people who cry wolf constantly. There are people who've been predicting imminent catastrophe for decades. But here's the difference. Those people are making predictions based on ideology or hope. They want the system to fail because they've bet against it. What we're talking about here is different. We're not predicting. We're observing. We're watching behavior. And in finance, behavior matters more than predictions. When a bank the size of Morgan Stanley tells its clients to exit a market entirely, That's not prediction. That's action. That's behavior. That reveals information. They're not crying wolf. They're showing you the wolf's tracks. They're showing you the torn fence. They're showing you the blood on the ground. The wolf might not attack today. It might not attack this week, but something has changed. The danger is real. The threat is imminent. And the people who know are acting accordingly. Your job isn't to predict exactly when the break happens. Your job is to recognize the pattern and position yourself intelligently. If you wait until mainstream media is reporting the crisis, you've waited too long. If you wait until your financial advisor calls you in a panic, you've waited too long. If you wait until you can see the problem clearly with your own eyes, you've waited too long. The time to act is when the smart money acts. And the smart money is acting now. Think about what you're risking by ignoring this. Think about what you stand to lose if the paper market collapses and you're holding paper. Think about the feeling of watching the system break while you're stuck in positions you can't exit. Think about the regret of knowing you had warning, you had information, you had time, and you chose to do nothing. That's a heavy burden to carry. Now think about the alternative. What if you take this seriously? What if you assess your exposure honestly? What if you make intelligent adjustments while you still can? Worst case scenario, nothing happens. And you own tangible assets instead of paper promises. You've given up some potential paper gains in exchange for eliminating counterparty risk. That's not a bad trade. Best case scenario, the system breaks exactly like the warning signs indicate, and you're positioned correctly. You've protected your wealth, you've avoided catastrophic losses, you've moved before the crowd. That's how generational wealth gets preserved. This is dark economy. This is what we do. We watch the players who matter. We track their behavior. We identify patterns. We warn you before the mainstream catches on. And we give you time to think, to analyze, to make decisions based on intelligence instead of panic. Most people operate in reactive mode. Something happens and they react. Markets crash and they panic sell. Systems break and they scramble. We operate in proactive mode. We see the setup, we position accordingly, we act while others are still sleeping. The silver market is showing every sign of structural failure. Collapsing inventory, surging delivery demand, exploding counterparty risk, major institutions evacuating, hard deadlines, emergency exits. These aren't subtle clues. This is a 5-alarm fire. The question isn't whether smoke exists. The question is whether you're going to walk out calmly now or wait until everyone else smells it and stampedes for the doors. History is watching. This moment, this setup, this pattern will be studied for decades. People will look back and ask, how could anyone not see this coming? The warning signs were everywhere. The institutions were exiting. The data was clear. How did so many people stay in the building while it burned? Don't be part of that cautionary tale. Don't be the person who had information and ignored it. Don't be the person who trusted the system right up until the moment it failed. Make no mistake, when this resolves, when the chaos settles, when the dust clears, there will be winners and losers. The winners will be the people who owned physical assets instead of paper promises. The winners will be the people who understood counterparty risk and eliminated it. The winners will be the people who acted while there was still time. The losers will be the people who trusted that markets always work, the people who believed their brokers when they said everything was fine, the people who waited for permission or validation before acting. Which side of that line do you want to be on? The countdown isn't loud, it never is. Financial collapses don't announce themselves. They build quietly in the background while most people are distracted by daily noise. And when they arrive fast, faster than anyone expects, faster than you can react. The only defense is positioning before it happens. And the only way to position before it happens is to recognize the pattern while it's still forming. Morgan Stanley recognized the pattern. Their risk managers saw the data. Their models showed them the outcome, and they made their choice. They're getting out. They've shown you their hand, quietly, deliberately, early. Now the question is, what are you going to do with that information? Are you going to dismiss it? Are you going to wait for more proof? Are you going to hope that somehow you'll have time later? Or are you going to take this seriously and act accordingly? The bridge is disappearing, slowly at first, then all at once. And when it's finally gone, when the gap is too wide to cross, the only thing that will matter is what you were holding before it collapsed. Paper promises or physical reality? Make your choice, but make it soon. Because time is the one resource you can't buy back. This is dark economy. Stay informed, stay rational, stay ahead of the crowd. Subscribe, comment, share, and whatever you do, don't ignore the exits when the people who built the building are already leaving. The next video is coming soon, and trust me, you're going to want to see it.